G'day folks, welcome back to another quick update for natural gas. Now today we're only doing the commodity price on the charts. We're not going through the ETFs. I'll cover those in the next couple of days. So today the price has actually dropped further from where we were in the last update. We're going to include the back testing to show you the results of that back testing for the stop loss approach and the average down approach. So for natural gas on the monthly, it's still very bullish with the price and the CCI above the respective moving averages. Likewise on the weekly. But notice, as we said in our last video, the CCI is dropping back towards that moving average range on the weekly, with a couple of a few weeks now of bearish candles. On the daily, this has actually dropped further below our previous support at 39.45, with a very major candle there, and that's also showing a very bearish decline still on the CCI. So bearish trades only should be taken on the intraday. Looking at the intraday charts, what I've got here, the color coding as well. So where the green on both the price and the CCI is showing green, that's ideally where you want to go long, and where it's showing pink or red, that's ideally where you want to start taking short trades. And currently we're in this short trading period, and you could have taken out one of those candles there even within that moving average range, but I've started the back testing from that candle there, and I'll cover that in a second. But before we go there, on the hourly chart, you'll notice here in our last video we drew this bullish divergence to that point versus lower lows on the price. Now since then the CCI has dropped slightly further, but that's still a bullish divergence because that low is still higher than that previous low. So if we drag that out to that point, so again a bullish divergence still in play. So again what that means is we want to see a bit of a retrace before we start getting too ahead of ourselves. But if it starts pulling back from where it is now, if we drew a Fibonacci to that high there, we expect it to reach roughly this 23.38% level. So again, I'm not going to draw that target yet until we see this starting to pull back towards that moving average range of both the CCI and the price. So this is the back testing for the stop loss approach and the average down approach, and the parameters for those are in the parameters on a separate slide. But again, using the daily as a reference, we take short trades only, and I've entered these back tests from the 12th of March, which is about that candle there. So the stop loss approach, you'd still be in the trading today if you were trading the stop loss approach, and that's generated $800, and the average down approach has generated $6,500. It's still going. So again, just be careful of this bullish divergence, but I mean, just let it go. The strategy I'm using is when this breaks into that moving average of the daily, you close out the position. So if you're considering going short now, it might be a bit too late because you might have missed the boat on this one. But again, you always take the trade with a fresh breakout. That's ideally the way to do it. Whereas if you go in short now, you might start seeing a bit of a retrace because of this bullish divergence, in which case you'll be probably hitting a bit of a loss if that started retracing back towards that moving average range, which is where we close out the positions. So here are the back testing or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade one contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is one contract, next lot is 3, you've got a total of 3 contracts now running, add another 4, you've got a contract, 7 contracts running, add another 8, and then you've got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now, trading shares is very similar. Invest per trade $1,000 per trade. So you invest first $1,000, next lot is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest one contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000, take profit is 3%, and again stop loss when the CCI 150 turns into the moving averages. Obviously, you can invest more than $1,000 in any of these trades, but just you've got to be very careful of the your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame. because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're the smaller take profit return. To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.